76, hierarchy of GAAP. We did it a couple of years ago, but might as well do it again. 79, certain investment pools and participations. And then next year, we have the second phase of 73. We have 74 for your OPEB plans that are standalone. We have 78, which focuses the scope as GASB 68 on certain multiple employer pension plans. It kind of limits the scope. 79, again, the second phase of the investment pool. 80, some clarification on blending of component units. And then good old 75 in June 30, 18. Are you guys ready for that? You're talking to your actuaries and getting everything set up for that. And then 81, we have some irrevocable split interest agreements. And those are kind of interesting, mostly affecting universities and hospital foundations. And then 82 is kind of the last GASB cleanup, GASB 68 cleanup. All right, so jumping right in. So 73, accounting and reporting for pension plans not within the scope of GASB 68, so that's the first half. And then the second half is the amendments of certain provisions of 67, 68. So when we're not in the scope of 68, so there's no trust. And when they say a trust for 68, it has to be irrevocable. The assets have to be dedicated for payments for pension plan members, and it has to be legally protected from creditors of the employer and employee, and no standalone financial statements. And because those assets aren't in a trust, you can't use them to offset the total pension liability. And so the assets need to be shown on the face of the financials of the client. And because those aren't in a trust, you can't use those assets to offset your total pension liability and arrive at net pension liability. And you can't use the discount rate. You have to use the discount rate of the 20-year tax-exempt bond. You can't use the long-term rate of return. You don't get the benefit of that. And some of these plans, actually, Amy was talking to me about it, that CalPERS has a replacement benefit plans. Does anyone out here have any plan like that? CalPERS replacement benefit plan? Okay. Well, hopefully you don't, because CalPERS said that they're probably not going to provide the GASB report for those plans, but they might give us the census data so we could do an actuarial report on our own. Okay. And so this part is effective for June 30, 17. The not in trust. So the clarification for disclosures, which is effective for June 30, 16, where we have to have a statement that there's no assets in trust. We have to have the same kind of disclosures as 68. So we have to have the footnote disclosures and then 10 years worth of RSI, required supplemental information in the back, even if not in trust. And then it kind of narrows the scope that talks about what we have influence in. So we don't have influence in external economic factors, so we don't need to put any of that information in our footnotes. We do have some about changes in our investment policy, so those are items that we should be disclosing. So again, this part is June 30, 16, so it kind of limits what we disclose for only the things that we have influence on. All right, so GASB 76, the hierarchy of GAAP, and this one, I think it was 62. So this is going to amend part of 62 and completely supersede 55. But 62 was about 3 years ago, or 4 years ago, I think it was. So it seems like we do this every once in a while. But we're doing it now into two categories. So we have Category A, which are actual GASB statements and interpretations currently issued in effect, and then you have Category B, which are technical bulletins, implementation guides, and literature from the AICPA that has been cleared by GASB. So this is kind of a step up because the implementation guides under GASB 55 was actually level 4, so now it's technically level 2 or B. So it kind of brings that up to more authoritative, which helps us a little bit in interpreting these. So what do you do if it's not in category A or B? We have some guidance there as well. We can look at some of the concept statements, FASBs, AICPA literature that's not cleared by GASB, so long as it doesn't contradict with GAAP. And handbooks and articles, so your journal of accountancy that you get every month, you can use that. And then my favorite at the very bottom of the list was accounting textbooks. Who remembers their intermediate accounting textbook? I do. That thing was heavy. Really heavy. Yeah, UDPA, for all my St. Mary's people out there. So effective date, June 30, 16. All right, so now getting into the start of clarification of 68. So this one narrows the scope of GASB 68 and excluding certain cost-sharing multiple employer benefit plans. So plans that are not a state and local government are not included in 68. That provide benefits to both government and non-government employees, those don't need to apply 68 to. And then plans that there's no identifiable primary or predominant government employer, and that would be like the Taft-Hartley plan. So I don't know if you have any of those in your agency, but those are normally organized under industries and also union groups. So there's no really primary government contributing to them. So they are excluded from GASB 68. So that's June 30, 16. All right. So here's the elephant in the room. So why did GASB do 74 and 75 and 67, 68? And kind of what I read is they're kind of leaning or evolving away from the whole just focusing on the current financial resource measurement. And they wanted to really show users and readers of city reports or financial statements that there are these large liabilities out there that we want to make sure that as a user of these financial reports, you know they're out there. So obviously net pension liability, and now we're going to have net OPEB liability. So it supersedes GASB 43 and 57 and also 45, and it pretty much mirrors the effects of 67, 68. A couple of little changes here and there, but as in terms of like measurement date and valuation date and disclosures, it's pretty much the same. So for your standalone plans, June 30, 17 is when that needs to come into effect, and then for your employers, June 30, 18. So we have a couple years to build up your retirement plan before that happens. So for plan and asset reporting, this goes for defined benefit plans and defined contribution plans. They have to be in a trust. So again, it has to be irrevocable. The assets have to be dedicated for payment of OPEB plan members, and if it's not, and legally protected from creditors for employee and employer. And if it's not in a trust, we've kind of already fixed the GASB 73 where we cleaned up the non-trust for the pension. So in this one we have that. So if it's not in the trust, same thing. You have to record the assets on the face of your financials, and then you have to do the total OPEB liability, and you cannot use the long-term rate of return. You have to use the 20-year tax-exempt bond. And then the notes in the RSI, or required supplemental, are really focused on the measurement of defined benefit liability for the employers and the changes therein. So the definition of OPEB has not changed in this. So other post-employment health care benefits, so that would be your medical, your dental, your vision, your hearing. Other forms would be death benefits, life insurance, disability, long-term care. Things that are excluded would be sick leave or termination benefits. And then for the employees, or for the employers, they have to record it if they're legally obligated to make these payments, or they make the payments for the OPEB when they are due. So like with 68, the total OPEB liability is from the actuary, and they project that out, and then we can reduce it by the plan's fiduciary net position. If it's a trust, like I said earlier, you can apply that against that to come up with a net OPEB obligation, or if it's non, you just do the total OPEB obligation. For the measurement date, it's the same as 68. It has to be no later or no sooner, I guess, than the prior fiscal year end, and no earlier than the current fiscal year end. And the actual valuation has to be obtained, they said biannually, but no more than 30 months and 1 day, and then we can roll it forward to the measurement date. Assuming there's no changes, significant changes in the assumptions, otherwise you probably need a new actuarial valuation. And the measurement date has to be consistent from year to year. We can't switch that around as we feel necessary. So in measuring the change in liability, we have to look at the actuary key assumptions. The salary increases, inflation, investment rate of return, mortality rates, discount rates, and then the new thing this year, which is different from 68, would be the healthcare cost trend rates. So we're hoping we'll get that from the actuary as well. But those are some of the assumptions that they'll use to project this out. And you as you know, clients here, you have to be okay with them, those assumptions. So you have to have a discussion with the actuary. And then as auditors, we have to make sure that those assumptions are reasonable. So when looking at this, there's 3 steps. We project, we discount, and then we attribute. So I think of it as PDA. I went to a very off subject. I went to a very small private school for high school, and my then girlfriend, now wife, used to get in trouble for PDA. Does anyone know what PDA is? Anyone go to private school? Public display of affection. Apparently we can't do that at private school. But anyway, off subjects. So we project out the benefits for the current, former employees and the beneficiaries. We discount it to present value, and the discount rate has two aspects to it. You have your long-term rate of return, and then you have the 20-year tax-exempt bond to the extent you don't have enough money to pay for the benefits. And then you attribute it to for employer service years. So PDA. Most of the changes in the OPEB liability are recorded in the current year and OPEB expense immediately, except for a couple that are over a closed period of the average life of the plan members, and that would be difference between expected and actual experiences in regards to economic and demographic factors, and then changes in assumptions. For your cost-sharing plans out there, you must be in the trust, so irrevocable, dedicated, and free from creditors. And then you show your percentage share of the OPEB liability, the OPEB expense, deferred inflow and outflow resources. Pretty similar to GASB 68. And then lastly, for the footnote disclosure, similar to 68, we have to also do, same as 68, the change 1% in the discount rate for the OPEB liability. And then the new one is we have to do a change in a 1% up or down for the healthcare trend rate, which actually I'm kind of curious what that's going to look like because, as you know, healthcare is going up so much. In the RSI, for the single or agent plans, 10-year information for the net OPEB liability, ratios on funding, actual determined contributions, and then for your cost-sharing plans, we need percentage share of the net pension or net OPEB liability, ratios on funding, and then contractually determined contributions. And again, 10 years, so as these accumulate, we'll drop off until we have 10. So that's GASB 74, 75 in a nutshell. So 77, having to do with tax abatement disclosures, and this also kind of came down to, GASB wants the reader to know that there's revenue out there that we've given up or we don't want anymore. We've given a tax abatement for some reason, and usually the reasons are for economic development. So the definition, reduction in tax revenue that results from an agreement between one or more governments. So it could be the primary government, or it could be imposed on the primary government by like a county or something like that, and the individual or entity in which one or more governments promise to forego tax revenue in which they were otherwise entitled to, and the individual or entity promises to make specific actions after the agreement has been entered into. That's kind of actually a key. It has to be after, it can't be before. That contributes to the economic development or otherwise benefit of the government or citizens of that government. So these tax abatements are usually used just for economic growth or development. And so just kind of a heads up now, you might want to start talking among your organization to see if any of these exist. And it's really a reduction in money coming in. So it has to be a reduction in property tax or sales tax. It can't be a rebate, money coming in and money going back out. So that wouldn't fall under this. It's just an actual reduction in tax revenue. For the note disclosure, we have to distinguish distinguish between which abatements are our own and which are imposed on us by another government, like a county or something like that. And sometimes these counties will actually reimburse the city or the entity for the lost tax revenue. So we have to disclose them either individually or in aggregate, and the GASB gives a quantitative threshold method that you can use and use your professional judgment to which ones you want to break out individually or show in total. And they suggest using like maybe a percentage of revenue or a dollar threshold, and then we actually eventually, I'll show you later, but we have to disclose in the footnotes of what threshold we use to break those out. They have to be organized by type of program, so income tax, property tax, etc. And then disclose required, it has to be disclosed in the footnotes from the date it started all the way until the life of the agreement. So this might be pretty substantial. That's why GASB put in the avail, or allows you to kind of lump them together, because they realize that this could be a really big footnote disclosure if you have a lot of these. And the effective date for that is through June 30, 17. And then also just the quantitative threshold to break them out individually or in aggregate, that can change from your own tax abatements or ones that are imposed on you from another government. So you might have a higher threshold for ones imposed on you. So it's kind of hard to see this slide, so you can look at it in your handout there. But this kind of gives you what's required to be disclosed for each kind of abatement, if it's either your own or one imposed on you. Obviously, if it's imposed on you, you have a lot less disclosure. But the primary ones are really the amount of money being abated, the name of the program, and if there's any recapture clause is actually kind of an interesting one too. And then with anything, consider materiality for your own. So you can set a materiality if you don't want to, if it's a tiny little thing, talk to your auditor. We'd probably be okay with not disclosing it. All right, 79. So 79, certain external investment pools and pool participants. So this came down with the SEC changing the rules for the 2A7-like plans, and those changes went into effect April 2016. So if GASB didn't do this, we would have to require fair market value adjustments for things like CAMP, California Asset Management Pool, where normally those are recorded at amortized cost. So this standard kind of gives guidance if you elect to use amortized cost. The transactions have to be in dollar per share basis, so you buy, sell in dollar per shares. And then there's some portfolio requirements having to do with maturity, quality investments, diversification, liquidity, and then shadow pricing is at the end. And we'll talk about that in a second here. So in terms of maturity, at purchase, they can't be more than 397 days. The average maturity of the portfolio, the weighted average is less than 60 days, and the weighted average life is less than 120 days. In terms of quality, they have to be denominated in U.S. currency. They have to be the highest category from the credit rating of Moody's and S&P. And if you have a security that was purchased that originally qualified, but then it was downgraded or it fell below, you can still hold that, but it can't make up more than 1% of your portfolio. In terms of diversification, no more than 5% in one issuer. That exclusion, there's an exclusion there for U.S. Treasuries, certain agency securities, and CDs. And if you have repurchase agreements, you need to double check and look at the underlying investments there to make sure that we're still in compliance here. In terms of liquidity, no more than 5% can be liquid at any time. 10% must be liquid within a day. 30% must be liquid in less than 5 days. And shadow pricing is the actual net asset value per share of these plans or these pools. May be plus or minus $1 on a full value basis. So what this really wants you to look at is is the amortized cost that much significant than a fair market value? And they want you to look at that monthly, and it can't be greater than a 0.5% change. Otherwise, you'd be out of compliance here. So for disclosures for 79, if you're a pool, you're going to need the same fair value disclosures that we'll talk about later on with GASB 72, and any limitations or restrictions on withdrawal imposed on participants. If you're a participant in the pool, you have to do the other side of it. If there's any restrictions that you can take money out, you have to disclose that in the footnotes. So this is going to be effective June 30, 16, and for the pools, June 30, 17, because it was harder for them. GASB recognized that some of the pool quality, custodial risk, and chattel pricing information would be hard for them to get in time to do June 30, 16, so they're going to give them an extra year for the pools. So GASB 80, the blending of requirement for certain component units. And this really has to do with nonprofits, where the nonprofit, the primary government is the sole corporate member of the nonprofit. So before, the old requirements were same governing body. The services benefited pretty much the primary government. There was a burden benefit relationship, and then the debt was always assumed to be repaid by the primary government if the component unit was in default. And then we add on to that it has to be blended, again, if it's the sole corporate member of a nonprofit. Okay. So GASB 81. And this really has to do with universities and hospital foundations that get, charitable donations to them. We don't see a lot of these within cities or special districts, but they could be out there. So some examples of such agreements where there's going to be a donation would be a charitable lead trust. So that would be payments throughout the trust. Some of the payments are actually made to non-government beneficiary, like the survivor still. A charitable remainder trust, or a CRUT, where at the end of the agreement all the assets go to the primary government. Or you have a life interest in real estate, where you have a piece of land or some property that at the date of death of the donor will be given to the government. And so this GASB gives us some guidance on how we deal with these transactions. And it really all boils down to who is the trustee of the asset. If the government is the trustee in a lead and remainder trust, there's going to be an asset booked, a receivable or revenue. There's going to be, an asset and receivable, and there's going to be a deferred inflow and outflow for the unconditional lead interest that the government's going to get, and then there's going to be a liability for the interest that the government has to pay out to a non-government beneficiary, so like that survivor still there. In a life interest in real estate, there's going to be a capital asset booked or investment, depending on what the building or land's going to do for you, and then a liability for the estimated expenses to bring that land up to what the government's going to use it for. So, and then any other things, insurance, repairs, and then there's a deferred inflow for the difference between that asset and liability. So again, these are if the government is the actual trustee. Now, if there's a third party acting as a trustee, we have to be careful before we start recording assets. So there's a couple of things that we have to look at. We have to make sure that the government is specifically named in the legal document. The agreement is irrevocable. There's no power given to the third party to change any of the terms of the agreement. The donor has no influence over that third party. And it's legally enforceable, that we can fight it and we can get that asset if this goes to court. And so at that, we have a measurement, the fair market value each year. The change in fair market value runs through deferred inflow resources. Lead interest is recognized when you get the interest each year. And then for a remainder trust or a interest in real estate, at the end, or the death of the donor, that's when we record the revenue, because that's the termination of the agreement. So that's going to start in June 30, 18. All right. And then GASB 82. So this is one of the last ones this year for cleanup of 67, 68, and 73. It really has three parts. going over deviations from actual standards of practice, payroll measurements in the RSI information, and classifications of employee paid contributions. So deviations from the actuarial standards of practice. So in GASB 68, there's language in there that some people kind of read into that you can deviate from their practice and still be in compliance with 68. And I had this with one of my clients, well, a couple of my clients, having to do with ad hoc COLAs and if it was real or not. So technically that's a deviation from their standards of practice. The actuary put kind of qualifying language in the report, which we talked about anyway. But so now they're saying that any deviation from that and you're not in compliance with 67 or 68 or 71, or 73, sorry. And payroll measurement in the RSI, required supplemental information. It used to be in the GASB 68 that it was covered employee payroll versus employee payroll. Or I'm sorry, versus covered payroll. And covered employee payroll includes pensionable and non-pensionable amounts. So it was kind of difficult for some governments to get those amounts to comply and put it in the required supplemental information to build your 10 years table. So GASB changed that. So now it's just going to be covered payroll or just pensionable payroll is required in the required supplemental information. And then the last thing 82 does is it clarifies classifications of employer-paid member contributions. So employer-paid pension contributions, originally in 68, the employer had to footnote it in the disclosure that they're paying for member contributions. Now you don't have to footnote that. And furthermore, it gives clarification that those should be, those member-paid contributions should be recorded as other compensation. So GASB is always a good resource for their website. They've got great summary of the statements as well as the full text. You can always call us. We're a good resource too. With that, I'd like to open up to any questions you might have.
That's my part. Come on. Let's have questions.
Nothing on implied subsidy?
Oh, yes. Yes.
The pension-related GASBs, is this a tsunami that's facing us right now, or is it likely that going forward we're going to be dealing with new pension-related GASBs on a regular basis?
I think the cleanup is kind of coming down. It's almost done.
It's narrowing. I expect that I believe there's one more exposure draft that are just cleanup GASBs. Nothing that's as grand because they were happy. And with the OPEB GASB, if you were to read them side by side, the OPEB and the pension, they're very similar, so that kind of tells you the GASB was happy with it, because if they had made a lot of changes to the required disclosures in the OPEB, you could have expected another change in how the accounting would need to be done with pensions. So we don't anticipate and haven't heard anything. There aren't any, like I said, the ones that are coming out are just cleanups, like the one for 82, that little cleanup to fix some things that were a little amiss in the statements. We do hope that there will be some clarification with employee-paid employer contributions, because they don't address that. From our perspective, we would say that you would treat it in the same manner as as far as how you account for the employee, how we say it backwards, employee-paid employer contributions, that you would use the same logic with employee-paid employer. But that's really a California anomaly when it comes to that. A lot of the other states don't have that. Yes, but we're hoping GASB will at least address it so it isn't a real question mark out there for too long. Yes. And something I wanted to clarify also on the tax abatement disclosures, as David was talking about with the revenue, that is revenue that you don't get. It's the agreement's there and you've agreed to do something before it even comes to the city, like a reduced assessed valuation or some other, some agreement through the BOE where they're not even sending the sales tax to you. So it's not the same, because a lot of you, as David said, have agreements where you have an agreement with an entity that you collect the either sales tax or property tax and then rebate through a check, writing a check to the entity. Those agreements already have to be disclosed. These are disclosing agreements that happen before the revenue even gets to your entity. So that's the little nuance with that statement that's not quite clear. Yes?
So in our case, in our city's case, we receive the sales tax, but we give it back to those businesses. So we're not going to be impacted by this GASB?
Correct. That's, yes. I don't know if you could hear the question. Yes, that's in their entity, they receive the sales tax and then write a check back to the entity.
Right.
No, those agreements are not affected by this GASB, but those should be disclosed. If they're material, those should be disclosed in your commitments and contingencies or another separate footnote disclosure in your financials now. Because that is a commitment. You've agreed, because there's usually those thresholds as to when what triggers the abatement, or the rebate, that you write to those entities. Yes.
And on that, I'd recommend you look at the Q&A. There's actually some really good examples of like gas tax in similar circumstances where they collect it and then use it for other reasons. So the Q&A is actually really short on this GASB, and it's really good information.
Yes, and we always refer to, we have the GASB electronically on our computers because we always have it with us, but just in case you aren't familiar with it, GASB's website, over the last couple years, they've made the GASB and the Q&A, or we call it the Q&A or the implementation guides, is available on the GASB's website, and it's very user-friendly, and you just have to click a box saying you accept their terms when you read it, but it's actually very user-friendly, at least from an auditor's perspective, it's user-friendly. Any other questions? Yes?
I'm assuming GASB 77 doesn't apply to tax sharing agreements as a result of annexation.
Correct. Agreed. The question was whether 77, which is the tax abatement GASB, whether it applies to tax revenue sharing agreements that come from as a result of an annexation. Correct. Sorry, I can't not talk with my hands. Those are not affected by that statement either. Yes. And again, if those are material agreements or something significant, then usually disclosure is required, but they're not affected by that GASB. Any other questions? Yes.
On this GASB 82, you said, David, covered payroll is the only definition out there using covered employee payroll is out there.
Correct. It's now covered payroll, not covered employee payroll.
Yes, it's back to the definition that you're used to. Oh, sorry. Well, for GASB 82, that changed between covered payroll and covered employee payroll. It was something that a lot of people didn't notice in GASB 68, that it used the term covered employee payroll, which meant 100% of the payroll for employees that participate in the pensions, not the pensionable payroll. It was a nuance that was missed by a lot, and you might not realize that your financial statements last year probably only disclosed covered payroll or pensional payroll, because CalPERS, if you participate in CalPERS, they don't know your total employee payroll. They only know your pensionable payroll. So this is a cleanup and a correction to that statement. We're going to talk about it when we go over 68 a little later this afternoon. But it's just, it's a cleanup, it's a correction and a fix, because what does that provide the reader really when we're talking about pensions and you have all of this other payroll that's not related to it? Does it need to be part of the required supplementary information? Okay. Any others? All right, then we're going to roll into the next section. Good.
Great. Thank you, guys.